Welcome back. Well, definitely pressured for the markets at this point. So we have the mid-cap index, which is down around 1.3% at this point. Just want to pull up Gland Pharma because that particular stock stands out. Gland Pharma, in fact, been in focus because of concerns on liquidity when it comes to its parent company, Fosun. But I have been talking to some sources. Remember that Gland Pharma, in fact, is owned by Fosun Pharma, and the concerns which are emerging with regards to liquidity, etc., is on Fosun International, which is basically the holding company of Fosun Pharma. So the street sources close to the company have indicated that the real problem or the issues probably which have risen are on the holding company front, which holds Fosun Pharma, and not really on the direct company that holds Gland, which is Fosun Pharma. So that stock still, however, a little pressured, so down around 0.7%, had a rough week this week. But let's move on to a CNBC-TV18 exclusive then. Our colleague Lata Venkatesh spoke to the top team of JPMorgan, Sanjay Mookim, Sajjid Chinoy and Madhav Kalyan of JPMorgan India to discuss the outlook for India as well as the global markets. Let's get you a part of that conversation.
I think India is an important point of discussion in boardrooms because of a set of factors. One, there is slowing global growth, and this is a market that offers huge growth potential. That continues to be a part of this conversation. When we talk to MNCs worldwide, we hear that consistently. The second is, even as they are looking at diversifying supply chains, India figures prominently in the conversation in the context of what we've done with PLI. But these are slow and deliberate conversations because this is a large investment that comes in.
Yes.
And so while the conversations are very promising, and we've opened up 28 odd sectors, 7 or 8 we see very good traction in the conversations that we're hearing.
Okay.
Private equity is always, it follows its trend.
But
they do make
private equity is using the domestic rally to exit. Do you see that as a trend that will continue?
I don't believe so. What we see is private equity moving to public markets is a maturity of a company's size and the continuum of what really needs to happen. We are in fact seeing a lot of private equity conversations that are around control and control transactions in multiple sectors. We're seeing that in healthcare, we're seeing that in financial. They want to get their heads in. They see it as an opportunity to build scale, get in with control, consolidate other plays, and we continue to see significant private equity interest. There are some of the biggest firms going and raising India-only funds at this point in time. So we don't see them actually, exiting
looking for an exit opportunity.
A market offers an opportunity, obviously they will look at opportune ways to harness the investment that they make.
But those are tactical, they strategically want to get in. Okay, I read your reports, Sanjay, and what seems to worry you is perhaps Sajjid telling you that this is a K-shaped recovery. That means, the GDP may have grown only 2% or 3% compared to 2 years ago, but an outsized portion has gone to formal companies, to the rich. How does that drive your investment picks?
So it's a very interesting question, Lata. And for a while, what we had been arguing is you follow the economy and you look at companies that benefit from that K-shaped recovery and sets of consumers. And therefore, we were very aggressively underweight the staples, for example, because we'd argued that the outcomes will be poor. At the moment, we've taken the contra view.
Okay.
Right? And this is because my investment thesis is very simple, especially if you are like a one-year investor, is you don't just buy growth. Growth is for private equity or 3-year, 5-year investors. Long-term, India looks great, as all of us have tried to highlight. But in the short term, what matters are earning surprises.
Okay.
What companies deliver versus expectations. And where
is that?
And so expectations are very high. And that is the big problem at the moment.
For the discretionaries, for the sectors catering to the rich.
Exactly. So while that momentum is true, and we updated that data last week and in our note, and it's still valid that the recovery trajectory for the richer cohort is faster than that for the, let's say, the lower income cohorts. But the expectations of growth from companies exposed to that rich sector now are very high. Okay. And any sort of sanity checks will tell you that in 2 quarters, you're starting to get a huge bunch of potential downside risks to numbers.
Okay. So then where is the positive surprise, if any?
So our first of all starting point is that the market looks very toppish, right? Okay. And again, I keep going out to clients and say, look, let's not confuse the promise, which is a 5-year, 10-year, 7-year vision, with what is going to happen to markets in 3 or 4 quarters. Yeah. So there are 2 or 3 separate drivers of those outcomes. And India's market exceptionalism that we've got, because India outperforming China, I can rationalize. India is now outperforming the SPX in dollar terms. Very difficult to explain, because the SPX is cheaper, it's got better earnings growth in the short term, and it's a hard currency asset. Right? Yes. So this looks very tenuous to me, and at some point there is a risk of a bit of a catch-up. Okay. So our portfolio positioning, therefore, is large cap, quality, defensive kind of stocks, which would be, let's say, the banks, the staples, and if you want some growth, maybe some real estate to add to that.
I'll come back to the banks argument after analyzing, rupee and rates. How would you worry about the rupee at all, Sajjid? Trade deficit is an issue. But at the moment, financing is coming. FIs are biting.
I would not worry about the rupee. There is no need to panic. This is not 2013.
CNY is over 7.
Yes. Because we're seeing...
So should we not catch up?
So 2 different things here. We're seeing the strongest dollar, the DXY index, in more than 20 years.
Yes.
And when that happens, all emerging market currencies, all developed currencies will depreciate. And this may not stop anytime soon because the Fed has potentially much more distance to go. Now, the rupee discussion has to be, should we be using the exchange rate as a shock absorber? And I believe we should. When you have a current account deficit that's quite elevated and expected to remain elevated, there are 2 ways to bring it down. Either you really squeeze growth and demand and imports, which is not ideal, expenditure restraint, or you use expenditure switching, where you let the real effective exchange rate depreciate. Over time, exports pick up. Over time, imports are replaced by domestic substitute. I call an expansionary reduction in the current account deficit, right? So my hypothesis is always, let's do that. And I think one other point I'll just make is, remember, the current account is inextricably linked to the fiscal deficit.
Okay, well, some wealth of opinion coming in from the JPMorgan top team there. For the market still pressured, we'll do one thing, take a break. On the other side, shift focus from equities to commodities. Manisha Gupta, commodities editor, will be joining in. Stay tuned.